Shares of Affirm making a huge move, a full trading day after the news that the credit card alternative will be an option under Amazon Pay. Affirm stock up about 16%. I spoke with Affirm CEO Max Levchin about the integration with Amazon and his reads on the surge in jobless claims, Affirm's access to capital in the wake of the regional bank fallout, and more. We started with the Amazon deal, which centers on Affirm's place in Amazon's digital wallet.
Digital wallets are accelerating. We expect half of e-commerce to be done through some form of digital wallets. Being offered within the leading ones is really important to our mission of bringing honest financial products to all consumers, and this is one major step towards that. Very excited about it.
What's making the difference in which wallet customers choose and sort of choose to be a part of? If I can use Affirm because my credit quality is good enough, if I can use Apple Pay, if I can use my credit card, what are you finding makes the difference in people using Affirm?
I'm a little bit biased, but I think the wallets that offer honest financial products, ideally those offered by Affirm or made by Affirm, are the soon-to-be winners. But I think everything from excellent user interface, access to credit, products that really meet consumers where they are, that's what makes a winning wallet. And we are obviously very hard at work partnering with the very, very best ones.
What are you finding is different between your approach right now and other, even larger companies that are moving into this space? We've heard about Apple, we've heard about Amazon and others exploring this. But last time I talked to you, you said you're paying a lot of attention to credit quality. How much attention do you think they're paying, and how is that affecting your ability to compete for that end customer?
I think everyone better be paying attention to credit quality. The jobs report today is just another little signal that, hey, not all is ultimately going to be great in the U.S. economy, and the differentiation of payments providers, credit providers, is fundamentally a function of, are you good at underwriting or are you not? We've been paying attention to credit quality for 12 plus years, and it's been paying really good dividends. You saw it in our last earnings. We reduced delinquencies while the rest of the pack, both outside and inside the credit card issuing world, has been showing increased delinquencies. And so we're very focused on it. I think those that offer buy now, pay later products, that partner with buy now, pay later providers, are all very attentive to it as well right now.
Give me a read on initial jobless claims then, because there's some puts and takes in there. But from your perspective at Affirm, what did that tell you?
I primarily look into my own data, trying to figure out sort of the tea leaves of the U.S. consumer. Right now, the primary driver of spend shift in the U.S. consumer is still inflation. It is not yet pressure on jobs. We've seen folks move from buying discretionary items into consumables, non-discretionary items as long ago as almost a year ago now. We're still seeing exceptional growth in travel. That's a category where there's near insatiable demand, just post-pandemic, got to get out of town, got to see the world. And so that's doing really well, but you can see a lot of consumers trying to pull back a little on sort of outfitting that extra bedroom and spending a little bit more attention to how I'm going to feed my family. And so for the moment, things are solid, robust even, but prices are up and folks are careful to not overspend.
What about your access to capital? Regional banks, at least the prediction has been that they're going to seize up in their willingness to do loans at all, make loans at all. I think we had an analyst on Overtime just yesterday saying that lenders that have direct and consistent access to capital are going to do better, and sort of questioned Affirm's position, maybe in part because you're not a bank yourself. How has that played out for you, and how has your data and your history helped or not?
The good news is that we do not partner with regional banks for capital at all, so we do not have exposure to that segment. We have a really, really well-managed, very diverse set of programs that allow us to access capital, everything from selling whole loans to everything from hedge funds to large banks and insurance companies and everything in between. We also have a tremendous number of warehouse lines that we're able to tap when that's the appropriate thing to do. We securitize our loans, both publicly and privately. And so we have quite a variety of capital access points, and we did that very intentionally on the odd chance that there will be a disruption in any one of these channels. We have plenty of others to fall back on. So we've done really well. Obviously, the real impact on our capital access and really price of capital is the Fed moves, and the fact that the Fed appears to be settling into a policy that is a lot more paced is very good news for us. It allows us to plan our business a little bit better, allows us to negotiate with our funding partners a little bit more precisely. And so all of that is, generally speaking, good news for us. Our access to capital remains really strong. We are not constrained by capital access to grow the business, which is exactly how it should be. We're only constrained by our willingness to take the right amount of consumer risk.